Buckle up, folks, because today on Boss Economics World, we're diving headfirst into the economic dumpster fire that is the Trump administration's latest misadventure in economic policymaking. If you thought the first Trump term was a roller coaster of chaos, well, grab your popcorn, because round two is shaping up to be a full-blown circus, and not the fun kind with cotton candy. We're talking economic policy decisions so reckless, they make a toddler with a flamethrower look like a responsible adult. And at the center of this madness? Treasury Secretary Scott Bessent, the guy tasked with selling America's economic stability to the world while his boss, Donald Trump, plays economic Russian roulette with a $29 trillion Treasury market. Spoiler alert, it's not going well. Now, if you're one of our loyal viewers, whether you're a regular Joe worried about your 401k or a finance pro trying to make sense of this madness, you know we don't mince words here. We're not here to sugarcoat the government's economic mismanagement or pat the backs of policymakers who are driving the US economy straight into a ditch. No, sir. We're here to shine a spotlight on the economic blunders, the hypocrisy, and the sheer incompetence that's turning the world's largest economy into a global laughingstock. So, let's break down this mess from the ground up, point by point, and show you how the government's latest antics are setting us up for a recession that could make the great financial crisis look like a walk in the park. Let's start with the elephant in the room, Trump's Trade War 2.0, which kicked off with the April 2, 2025, announcement of the largest package of import taxes in over a century. Now, if you're thinking, wait, didn't tariffs cause chaos last time? You're spot on. But apparently, the Trump administration didn't get the memo, because they've doubled down on this economic lunacy. The result? A jaw-dropping $6 trillion was wiped out from the S&P 500 in the immediate aftermath, the biggest drop since the 2008 financial crisis. And while markets have clawed back about half of those losses, the damage to investor confidence is already done. Here's the kicker, folks, tariffs don't just hurt the countries they're aimed at, they boomerang right back to the US economy. Take China, for example, which is now facing a whopping 145% tariff on its goods with no end in sight. Sure, Trump might think he's winning this trade war, but let's look at the numbers. According to a recent report from the Peterson Institute for International Economics, US consumers and businesses are already paying an additional $130 billion annually in higher costs due to existing tariffs. And with the new tariff package, that number could balloon to $250 billion by the end of 2025. Who's footing the bill? You guessed it, American consumers, who are already grappling with inflation that's stubbornly hovering around 3.5%, according to the latest Consumer Price Index, CPI, data from the Bureau of Labor Statistics. But wait, there's more. The trade war is also tanking global growth, which is bad news for the US economy, considering exports account for about 12% of our GDP. The International Monetary Fund, IMF, just slashed its 2025 global growth forecast from 3.2% to 2.8%, citing Trump's tariffs as a primary driver of the slowdown. And here's the cherry on top, the Federal Reserve, already struggling to tame inflation without triggering a recession, now has its hands tied. Why? Because tariffs are inflationary by nature, driving up the cost of goods, while simultaneously slowing economic growth, a toxic combo known as stagflation. So, what's the government's response to this self-inflicted wound? Treasury Secretary Scott Bessent goes on Fox Business and says, nothing systemic here, folks. Oh, really, Scott? Tell that to the bond traders who triggered a fire sale on US Treasuries on April 9, 2025, sending yields on the 10-year note spiking to 4.8%, the highest level since 2011, according to Bloomberg data. Investors are losing faith in America's ability to manage its economy, and who can blame them when the White House is leaking contradictory tariff plans one day and announcing universal tariffs the next? This isn't leadership, it's economic whack-a-mole, and the moles are winning. Now, let's pivot to another ticking time bomb, the debt ceiling. Yes, folks, that old chestnut is back, and it's set to rear its ugly head this summer. For those of you new to this circus, the debt ceiling is the legal limit on how much the US government can borrow to pay its bills. And here's the fun part, Congress has to vote to raise it, which means it's always a political football. Twice in the past, 2011 and 2013, this game of chicken led to a downgrade of US debt's credit rating, and just last year, we got a stern warning from rating agencies like Moody's and S&P. But this time, the stakes are even higher. Why? Because we've got a perfect storm brewing, deep partisanship in Congress, an unpredictable Trump administration, and, wait for it, Elon Musk's tech bros storming the Treasury Department to disrupt the payment system. More on that clown show in a minute. For now, let's focus on the numbers. The U.S. national debt is currently sitting at a staggering $29 trillion, according to the latest Treasury Department data, and the Congressional Budget Office, CBO, projects that will need to borrow an additional $1.5 trillion in fiscal year 2025 just to keep the lights on. What happens if Congress fails to raise the debt ceiling? Well, missing a payment or delaying a Treasury auction isn't just a whoopsie, it's a global financial catastrophe. Representative Frank Lucas, a Republican on the House Financial Services Committee, put it bluntly, if we had one bad Treasury bond sale, the net effect would be pretty intense. Intense? Try apocalyptic. The US Treasury market is the bedrock of the global financial system, with over $600 trillion in derivatives tied to it, according to the Bank for International Settlements, BIS. A default would send shockwaves through everything from mortgage rates to pension funds, making the 2008 Lehman Brothers collapse look like a minor hiccup. And yet, here we are, with Trump egging on his MAGA loyalists in Congress to use the debt ceiling as a bargaining chip for tax cuts and deregulation. Meanwhile, Scott Bessent is stuck playing the role of America's chief bond salesman, trying to convince investors that US debt is still the safest asset in the world. Good luck with that, Scott, when your boss is treating the economy like a reality TV show. Speaking of reality TV, let's talk about the wild card in this economic circus, Elon Musk. Yes, the world's richest man, fresh off disrupting industries like electric vehicles and space travel, has now set his sights on the US Treasury's payment system. This is the system that processes 88% of all government payments, $5.46 trillion a year, according to the Treasury's Bureau of Fiscal Service, BFS. We're talking Social Security checks, state aid, and, oh yeah, managing the national debt. Musk's plan? Streamline the system by upgrading decades-old technology, slashing labor costs, firing civil servants, and, get this, reconsidering congressionally approved payments. Now, I'm all for modernizing outdated systems, but there's a difference between innovation and reckless meddling. The Treasury's payment system isn't some startup app, it's the backbone of the US government's financial operations, and even small hiccups could be disastrous. Remember the 2013 government shutdown, when payment delays caused chaos for federal workers and contractors? Now imagine that on steroids, with Musk's tech bros trying to move fast and break things, in a system that can't afford to break. Here's the real kicker, folks, this isn't just about efficiency. Musk's mission is part of Trump's broader agenda to shrink the size of government, which sounds great on paper until you realize it means slashing programs like Social Security and Medicaid that millions of Americans rely on. According to the Center on Budget and Policy Priorities, Social Security alone supports over 66 million beneficiaries, many of whom are elderly or disabled. Cutting those payments isn't streamlining, it's economic cruelty, plain and simple. And let's not forget the optics. At a time when investors are already jittery about US economic stability, do we really need a billionaire inventor with a track record of erratic behavior meddling in the Treasury Department? The bond market certainly doesn't think so. Yields on 30-year treasuries have jumped 50 basis points since Musk's involvement was announced, signaling growing unease among investors, per Bloomberg data. Now, let's zoom out to the global stage, because Trump's economic antics aren't just hurting the US, they're threatening the dollar's status as the world's reserve currency. For decades, the dollar has been the bedrock of global finance, giving the US unparalleled economic and diplomatic power. But that power is under threat, and the latest data is alarming. Since Trump's tariff announcement on April 2, 2025, the dollar has fallen more than 3% against a basket of major currencies, according to the US Dollar Index, DXY. Why is this happening? Economic theory says tariffs should strengthen the dollar by reducing imports and boosting domestic production. But theory doesn't account for a government that's eroding confidence in its own institutions. Investors are losing faith in US policymakers, and for good reason. Trump's attacks on democratic norms, like the rule of law, an independent Federal Reserve, and press freedoms, are spooking markets. Add to that the Biden administration's 2022 sanctions on Russia, which pushed countries like China and India to explore alternatives to the dollar, and you've got a recipe for a long-term decline in dollar dominance. Here's a stat to chew on: the dollar's share of global foreign exchange reserves has already dropped from 71% in 2000 to 58% in 2024, according to the IMF's latest currency composition of official foreign exchange reserves, COFR, data. And with Trump's isolationist policies alienating allies, that trend is only accelerating. Just last month, the BRICS countries, Brazil, Russia, India, China, and South Africa, announced plans to expand their use of local currencies in trade, a move that could further erode the dollar's global role. What does this mean for ordinary Americans? A weaker dollar means higher prices for imported goods, from electronics to gasoline, at a time when inflation is already squeezing household budgets. And for finance pros watching this unfold, it's a stark reminder that the US can't take its economic dominance for granted. So, where does Treasury Secretary Scott Bessent fit into this mess? Well, folks, he's the guy stuck juggling flaming torches while riding a unicycle across a tightrope, with Trump shaking the rope. On one hand, Bessent has to maintain investors' faith in the $29 trillion Treasury market, reassuring them that US debt is still the safest asset in the world. On the other hand, he's the face of Trump's chaotic economic agenda, tasked with negotiating tariff deals and managing the fallout from Musk's meddling. Bessent's trying to play it cool, telling Bloomberg TV that Wall Street's fear gauge, the VIX, has likely peaked and promising an orderly process on tariff negotiations. But let's be real, no amount of smooth talk can paper over the fact that his boss is the economic equivalent of a bull in a china shop. And Bessent's not exactly helping his case by snubbing international allies. He skipped a G20 finance ministers meeting in February 2025, a move that raised eyebrows among global policymakers. Here's the harsh truth, folks: Treasury secretaries are judged by their ability to instill stability and predictability, especially in times of crisis. But with Trump calling the shots, Bessent's job is less about economic stewardship and more about damage control. History shows that Treasury chiefs who thrive in crises, like Salmon P. Chase during the Civil War or Hank Paulson during the 2008 financial crisis, are the ones who think creatively and push the limits of their power. But can Bessent do that when his boss is an unpredictable loose cannon? So, there you have it, folks: the US economy is teetering on the edge of a self-inflicted recession, and the government's mismanagement is to blame. From Trump's reckless tariffs to the looming debt ceiling crisis, from Musk's dangerous meddling to the dollar's decline, every move this administration makes seems designed to undermine economic stability. And poor Scott Bessent is stuck in the middle, trying to sell the world on America's economic strength while his boss burns the house down. Here at Boss Economics World, we're not just pointing fingers, we're sounding the alarm. If the government doesn't get its act together, we're staring down the barrel of a recession that could wipe out trillions in wealth, spike unemployment, and erode America's global standing. The latest data backs this up. The Conference Board's leading economic index, LEI, is signaling a 70% chance of a U.S. recession by mid-2026, and Goldman Sachs just raised its recession odds to 35% within the next 12 months. So, what can you do? Stay informed, stay vigilant, and don't let the economic clowns in Washington fool you with their empty promises. And hey, if you liked this episode, smash that like button, subscribe, and share it with your friends. Because here at Boss Economics World, we're not just watching the circus, we're calling it out, one economic blunder at a time. Until next time, keep your wallets tight and your eyes wide open.